Welcome back to the deep dive. It is early 2026, and if you've been watching the financial headlines or even just, scrolling through your feed, you have seen the panic.
Oh, yeah.
There's this very specific ghost story that's haunting the market right now. They're calling it the death of SaaS.
It's the narrative that just will not go away. It's practically a horror movie for the tech sector.
And it's a terrifying idea for investors, right?
Yeah.
The theory goes something like this. Artificial intelligence gets so good so fast that it writes its own code, manages its own workflows, and basically runs the company.
And suddenly you don't need to buy all those expensive software licenses anymore.
Exactly. The subscription model, which has been the golden goose of Wall Street for, 15 years, is supposedly cooked.
That is the narrative.
Yeah.
And standing right in the center of that storm, right in the crosshairs, is the company we are analyzing today, Salesforce, ticker symbol CRM.
This is the big question we're tackling. Is Salesforce a legacy dinosaur about to be replaced by some smart chatbot? Or are they actually pulling off a pivot into something much, much bigger?
Are they the ones building the chatbot that eats the world?
Right. And to figure that out, we've pulled together a serious stack of documents. We've got a comprehensive research report from Compasscope, dated just a couple days ago, February 16th, 2026.
We also have a market update on AI impacts from that same day, and the full transcript from Salesforce's Q3 fiscal year 2026 earnings call, which was back in December 2025.
So our mission today is to unpack their transition. They're trying to go from being a, quote, Rolodex in the cloud to what they're calling an agentic enterprise. So for anyone listening who wants to know the business mechanics behind that stock ticker, let's get into it.
Let's do it.
Okay, so first, we need to level set on what this business actually looks like in 2026. Because I think most people hear Salesforce and they just think sales software, maybe a database for phone numbers.
And that's a massive oversimplification now. Looking at the Compasscope report, you have to stop thinking of them as just a CRM, a customer relationship management tool. That was the definition in, 2010.
So what's the definition today?
Today, you need to think of Salesforce as the operating system for the entire front office of a business.
Okay, operating system for the front office. That sounds impressive, but break that down for me. What are the moving parts?
You start with what they call the core clouds. These are the pillars holding up the revenue. You've got the sales cloud, which is the classic stuff tracking leads, closing deals, managing the pipeline.
Right, the original product.
The OG. Then the service cloud, which handles all your customer support tickets, your call centers, that sort of thing. And then you have the marketing and commerce clouds, which run your digital storefronts, your email campaigns, your ads.
So selling the product, helping the customer, and marketing the brand, that covers the basics.
It does. But here's where it gets interesting and, frankly, where the real value hides for an investor. It's the glue. It's the data and integration layer.
The stuff the customer doesn't necessarily see, but what keeps the lights on.
Precisely. You have the data cloud. Sometimes they call it Data 360. Imagine a massive vacuum cleaner sucking in customer data from everywhere, your website, your store, your app in real time, and putting it all in one place.
Okay.
And you have MuleSoft.
I always see MuleSoft in these reports, and I feel like nobody ever explains what it actually does. It sounds like a brand of socks.
It does, doesn't it? But think of MuleSoft as a universal translator. Modern companies use hundreds of different apps. Finance uses one thing, sales uses another, HR a third.
And they don't talk to each other?
Usually not. MuleSoft uses APIs, application programming interfaces, to make sure the finance app can talk to the sales app, even if they speak different computer languages. It's the digital plumbing.
And I noticed a new name in that plumbing section in the Compasscope report, Informatica.
Yes, the acquisition. That's a huge addition. Salesforce bought Informatica to really supercharge that plumbing. Here's the insight. If you're going to run AI, you need clean data. If your data is messy, your AI is stupid.
Garbage in, garbage out.
Informatica is the heavyweight champion of cleaning and integrating that data so the AI actually works.
So they have the apps, they have data glue. What about the interface? How do people actually talk to all this software?
Right, that's the collaboration layer, and that means Slack. But in 2026, Slack isn't just a chat room for sending gifts to your coworkers anymore. It is becoming the command center for AI agents. And underpinning all of this is the new star of the show, Agentforce.
Agentforce. We're going to hear that name a lot today. It sounds like a superhero team.
It's the key to their entire future. Agentforce is their platform as a service. Essentially, it's a factory for building AI agents. And we aren't talking about a chatbot that just answers FAQs.
No.
We are talking about agents that can autonomously do things, resolve a product return, update a customer record, negotiate a discount, schedule a technician.
Okay, and just to clarify the business side of this, how do they get paid for it all?
It's a mix. The bulk is still subscription revenue companies paying those recurring fees for licenses. That's the predictable cash cow. But there's also a big chunk from professional services, so sending in consultants to help set this massive machine up.
Because it's complicated.
It can be, yeah.
Okay, so they've built this massive fortress, but they aren't the only ones in this game. Who are they fighting against?
The landscape is incredibly crowded. The Compascope report lists the usual heavy hitters. Oracle, Microsoft with their Dynamics 365, SAP, HubSpot, and Adobe.
So why does Salesforce stay on top? I was looking at the retention rate in the report. It's 92%. That's just absurdly high for software. What's the moat here?
The moat is switching costs. And this is so crucial for investors to understand. Salesforce isn't just an app you use. It's mission-critical infrastructure. It holds all your customer data, your sales workflows, your service history.
So it's not like canceling Netflix where you just, stop watching.
Not at all. Ripping Salesforce out of a Fortune 500 company is like trying to perform a heart transplant while the patient is running a marathon.
Wow.
It's a massive operational disruption and takes years. Most CIOs would rather just pay the renewal fee, even if it's higher, than risk paralyzing their entire business for 18 months just to switch vendors.
That is a sticky product.
Extremely. Plus, they have breadth. Adobe is great, but they
Yeah.
focus mostly on marketing. SAP is the king of the back office manufacturing supply chain, but Salesforce spans the entire front office. And then you've got the network effects of their app exchange.
So if you leave Salesforce, you break all your other little plugins too.
Exactly. You pull one thread and the whole sweater unravels.
Yeah.
But no castle is invincible.
Right. Let's talk threats. What keeps their leadership up at night? Because Compascope definitely highlights a few.
Well, the big one is Microsoft. They can play the bundle game.
The bundle game.
Microsoft goes to a CFO and says, hey, you already pay us for Office 365, you pay for Azure cloud hosting, you pay for Teams. We'll throw in our CRM, Dynamics 365 for free or for, really cheap.
Oof. That is a hard argument to beat if you're just looking at a budget.
It really is. For a lot of companies, Microsoft's version is good enough. And good enough at a lower price is very tempting when the economy is tight.
And what about on the other end of the spectrum? The smaller companies.
That's HubSpot. They're simpler, cleaner, cheaper. They are absolutely eating up the small and medium business market, where Salesforce is often seen as too expensive and way too complex.
So Salesforce is the Ferrari, and HubSpot is the really nice Honda Civic.
And sometimes you just need the Civic. Exactly.
Okay, so they're defending the castle, but investors want growth. The report mentions a goal of hitting $60 billion in revenue by fiscal 2030. How on earth do they get there?
It's a strategy they call the agentic enterprise. This came through loud and clear on that Q3 earnings call. The thesis is this: growth won't just come from selling more software to humans anymore.
It's from selling the robots.
It comes from selling agents, autonomous AI to do the work. They want to sell you the digital employee. That's the primary growth driver. But they're also leaning very hard on cross-selling.
What does that look like in practice?
Well, over half of their enterprise customers already use multiple clouds, but Salesforce wants them to use all of them. If you use Sales Cloud, they want to sell you Service Cloud and Data Cloud. They're also really pushing these high-margin verticals. The life sciences cloud, public sector cloud.
Specialized clouds for specialized industries.
Exactly. And of course, inorganic growth. That means buying growth like we saw with Informatica.
But buying companies is so risky. We've seen tech mergers go sideways a million times. What are the big execution risks here?
It's significant. Integration indigestion is a real thing in the corporate world. They bought Slack, MuleSoft, Tableau, and now Informatica. These are massive companies. If those acquisitions don't talk to each other perfectly, the value proposition just falls apart.
Becomes a Frankenstein monster.
Precisely. And then there's the AI risk itself. Is there a risk that people just don't use it?
The AI adoption lag.
Yes. Enterprises can be slow. They might be terrified of the workforce disruption. Firing people to replace them with bots is a PR nightmare. Or they just don't have the budget to turn Agentforce on.
Right. And pricing pressure is real, especially in a tight economy.
Very real. Customers might downgrade to HubSpot. And there's also the risk of what they call multi-cloud saturation. If your biggest customers have already bought everything you sell, well, how do you sell them more? You hit a ceiling.
I want to pivot back to that death of SaaS narrative we started with, because there's a very specific fear here. It's called seat erosion.
Right?
If I have an AI agent that can close support tickets and draft emails, I don't need to hire a junior salesperson. If I don't hire the human, I don't buy a Salesforce license for them. Doesn't that mathematically kill their business model?
That is the bear case. That is what the pessimists are shouting from the rooftops. But Salesforce has a rebuttal, and it all centers on a concept called data gravity.
Data gravity, I love that. Explain it like I'm 5.
Okay. Think about the AI models, the LLMs. In 2026, they're becoming commodities. You can get a smart model from OpenAI, from Google, from Meta, anywhere. But the model is useless without context.
It doesn't know my business.
Exactly. It doesn't know who your best customers are, or what they bought last year, or that they hate being called on Tuesdays. Salesforce holds that data. The data cloud sits on over a petabyte of data for each large enterprise.
So the argument is the AI is the engine, but Salesforce has the gas.
Perfect analogy. You can't run a good AI agent without that specific fuel. So their argument is, you'll come for the AI, but you'll stay because we remember everything about your business.
But if they are selling fewer seats because fewer humans are working there, how do they make up the revenue?
They're shifting the monetization model. This is a big pivot. They're moving toward consumption-based pricing. So instead of just charging per user per month, they're starting to charge per conversation or per token.
Tokens, like arcade tokens.
Sort of. Think of a token as a piece of a word processed by the AI. Every time the AI reads or writes something for you, the meter's running. It's like a taxi meter instead of a flat car rental fee.
Ah, okay. That makes sense.
And the Q3 earnings call mentioned they processed 3.2 trillion tokens.
3.2 trillion, that is a massive number.
It is. It shows this is real usage, not just people testing it out. And here's the kicker on the math. They believe if they price these Gen AI credits at roughly 25 to 35% of the cost of the underlying license, they could actually expand the revenue per user, not shrink it.
So even if you have fewer humans, the humans who are left are spending way more to power their AI armies.
That is the bet. They're betting the consumption volume will more than outweigh any seat loss.
Do we have any proof this actually works, or is it just a nice slide in a presentation?
Well, they have examples. Look at Williams-Sonoma. They have an agent called Olive. It now handles 60% of their customer chats effectively, without a human ever touching it.
60%. That's a huge efficiency gain.
It's massive. Or look at the UK police. They have a bot called Bobby.
Bobby the Bobby.
Bobby the Bobby. You have to appreciate the humor. It handles non-emergency calls and has reduced the demand on human officers by 20%. It's real, tangible value.
Those are impressive stats. So let's look at the hard financials from that Q3 call. How did the numbers actually look?
They look solid.
Yeah.
Revenue hit $10.26 billion, up 9% year over year. That's steady, but the cash flow, that's the monster here. They're expecting nearly $15 billion in operating cash flow for the full year.
15 billion. That's a war chest.
It is. It gives them so much room to maneuver, to buy companies, to invest in AI. And the CRPO was up 11%.
Okay, break that term down, CRPO. Why does it matter?
It stands for Current Remaining Performance Obligation. It's basically the backlog revenue that's under contract but hasn't been recognized yet. It's the best predictor for the future health of a SaaS company.
So the pipeline is healthy.
It's very healthy. And we mentioned Informatica. That deal closed 3 months ahead of schedule. That was a big operational win. And they aren't just hoarding the cash. They returned $4 billion to shareholders in Q3 through buybacks.
Right, buying their own stock. I also saw some specific wins in the report that were just mind-blowing. What about the IRS?
Oh, yeah. The IRS. This is my favorite example. They used Salesforce to automate manual activities by up to 98%.
98%.
98%. They dropped the time it takes to open a tax court case from 10 days down to 30 minutes.
10 days to 30 minutes. That's the kind of efficiency AI promises, but you rarely see.
Exactly. And you see Costco using it to digitize member experiences.
Yeah.
General Motors using Slack for 96,000 employees. These are massive, complex organizations going all in.
So for the listener who's looking at the ticker symbol CRM, let's build a checklist. What do we need to watch in the next year to know if this agentic pivot is actually working?
Okay, there are 5 keys to watch, according to the Compasscope report. Number 1 is Agentforce adoption. We need to see if these pilot programs are turning into paid recurring revenue.
Right. It's one thing to test the bot. It's another to let it run a department and actually pay for it.
Exactly. Number 2 is multi-cloud cross-sell. Can they keep selling Data Cloud and Slack to the people who already bought Sales Cloud? If that slows down, overall growth slows down.
Got it.
Number 3, Margins. They're targeting operating margins over 34%. That's very healthy. But AI is expensive. Can they keep margins that high while spending a fortune on AI infrastructure?
That's the tension right there.
Correct. Number 4, the competition. Watch Microsoft and HubSpot very closely. If the economy tightens, do we see market share bleed to them? And number 5,
Let me guess. Data cloud.
data cloud execution. Their whole strategy relies on customers consolidating data with Salesforce and Informatica rather than using a standalone player like Snowflake. That's a tough battle.
So to wrap this all up, we started with the death of SaaS. Is Salesforce dead?
Far from it. Salesforce is betting the farm on becoming the brain of the enterprise, not just the filing cabinet. They're trying to turn the AI disruption from a threat, that seat loss fear, into a lever.
It's a bold pivot, that's for sure. They are definitely not sitting still.
No, they're moving fast.
And here's a final thought for you to chew on. For 20 years, Salesforce has been the king of the subscription model, predictable, boring, beautiful, recurring revenue. But as they transition to this consumption-based pricing for AI agents, does the stability of that business model change?
That is the big unknown.
They're trading predictability for potential explosive growth, but consumption can go down just as fast as it goes up. Is that a trade investors are ready to make?
Only time will tell.
Thanks for listening to this deep dive into Salesforce. We will see you next time. This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.